Good morning, welcome to PEM's 2024 budget. It's great to have so many of you here. Obviously a heavy trick-or-treating night for some of you. And as this has landed in half term, great to have as many turn up. So the usual bit of housekeeping. It would be quite interesting to say there are fire alarms planned, but there aren't. So if the alarm does sound, then through the doors that you came in. But hopefully you've had a chance for some coffee, for some breakfast, and a chance for a chat with some of your PEM contacts. After our presentation this morning, speakers and a lot of our tax team will still be around if you have any questions or queries that you want to raise with them. So we do have a tight timetable. We try our best to keep on track. I know my colleagues have a lot to say in a good way, that is. We aim to finish by 10 o'clock. There is a lot of content, so we may have to restrict the Q&A session. However, please do use Slido. So on the screen behind me, use the link or the QR code to ask questions through the event. And we will share those questions and hopefully some good answers with you after the event. So a fair bit has happened since our last budget seminar. We have obviously a new government in place. And since they came to power in July, there have been dire warnings over the state of the economy. And you may have heard them occasionally mention this black hole. They've kept it very quiet. So tax rises, difficult decisions have been trailed for many months. And as has become the norm, quite a lot of it has been gently leaked out after the last week or so. But there were still quite a lot of surprises. Probably the most eagerly awaited budget for a number of years. And although the last 14 years set the bar fairly low, this budget didn't disappoint. Whatever your politics, it was quite a confident performance by the Chancellor when she set out her statement to restore economic stability. So as we ponder how a massive increase in employers' NI can really promote growth and economic stability, I just wanted to pick up on a few points that don't fit neatly into our presentations this morning. So the government are very keen on closing the tax gap. And what does that actually mean? It means significant investment in HMRC, new staff, new technology, and new regulations for tax advisors. So we fully support better regulation. It shines a light on the more unscrupulous tax advisors out there. And obviously, an increase in the headcount brings possibly the aim that we all want, someone to pick up the phone when you call HMRC. Let's not wait too much for that. I think having watched the budget, I think the biggest cheer actually came when the Chancellor announced a 1 pence cut in the duty on a pint of beer. So I suppose that says quite a lot about the MPs rather than anything else. But good news if you like a drink, less so if you want a cigarette or a roll-up with it, as tobacco rates are increasing over the course of the Parliament. Even worse if you like to vape, with a flat rate duty being introduced. But if you do buy gummy bear or bacon vapes, and apparently they do exist, then you probably deserve it. So from next April, the national living wage will increase to £12.21, and the minimum wage will increase to £10 for 18 to 21-year-olds. Now, at the other end of the age spectrum, the government have committed to maintain the state pension triple lock, and they are increasing pension levels by over 4% from the beginning of April, in line with earnings growth. And as per the manifesto, and this wasn't in the small print, the Chancellor confirmed that VAT, standard rate VAT, will be charged on private school fees, and that charitable rate relief on business rates will be removed from private schools as well. So there was a brief mention of Cambridge. There's a £10 million funding package for Cambridge Growth Company, been set up to deal with infrastructure that Cambridge needs to fulfill its potential, it says. Having worked in Cambridge and seen how long and expensive a cycle pathway down Milton Road takes, I think 10 million is probably not quite enough. There's more money for the East-West Railway, again. Connection for Oxford, Milton Keynes, Cambridge. I think I've mentioned that probably the last 8 budget seminars we've had. So things are moving, but clearly at quite a slow pace. I'm sure you've all digested quite a bit since Rachel Reeves' announcement on Wednesday. But to bring all the important points together, I'm delighted to introduce you to Stephen, to Angus, Jan and Sancha, who will be guiding you through the delights of, got to get this right, changes to the non-dom regime, growing and structuring your business, and your personal tax position. So Stephen, over to you to lead off.
Good morning, everyone. I'm Stephen. I'm a partner of the private clients team, and I'm going to talk you through on the international aspects, and it's centering on the non-dom regime, or the new regime that's going to take its place. Make no apologies for that. It's a fundamental change in the scope of UK taxation. And there are no real big surprises. It was announced, obviously, on the 6th of March in the previous budget that there was going to be these changes, but actually now we understand what they are, or what they're going to be. And it's moving to a UK tax residence position, removing this domicile, which is probably as tricky to understand as what a working person is from the budget. So it makes it simpler, but that doesn't mean that there's not complexity. And I do apologize, there's quite a lot to go through, so I will be skipping through, just trying to pick up the main points, because it's a big change in the scope of income tax, capital gains tax and inheritance tax for people. Previously, we only centered on non-DOMs, but actually this affects UK DOMs as well. So it widens the scope, makes it a bit more challenging as well. So what does this new regime do? Well, from the 6th of April, it provides 100% relief from foreign income and gains, and it's aimed at new arrivals. So that's people that have got a clear consecutive 10-year period of non-UK tax residence. So that's going to be key to understanding what people's UK tax residence position is when they've been UK resident and when they haven't. It is limited, so the relief is much better. You get full 100% tax relief. You don't have to worry about the remittance basis, basically keeping when funds are in the UK, when they're not. The remittance basis is more of deferral. This is a straight 100% tax relief if you choose to claim it. It does sort of piggyback on some of the remittance basis rules. So if you claim it, you lose your personal allowance, your annual capital gains exemption, and you don't get relief for foreign losses. But it's much shorter, so it's more beneficial, but it's much shorter, and it's also wider. So previously the remittance basis was non-DOMs. This actually impacts UK DOMs, as I say as well, so it impacts everyone. But you do need that 10-year clear non-residence period. So what is foreign income and gains? Very lucky. Again, they piggyback on the remittance basis rules, the rules that we're long established. We understand what they are. There's no changes on that. What is a bit significant, if you do have a settler who's retained an interest in their offshore trust, those foreign income and gains will be within that as well. So it's just making sure that you understand that, because the protections that used to apply no longer do. So essentially, as well, overseas work days relief, that remains. It's actually improved slightly, that you get an extra year. Currently, you're 3 years. Now it falls in line with the 4-year big regime, for want of a better term. And that was good, because originally the proposal were that it stayed at 3 years, so that was a bit confusing. But the Revenue had a listening event, which we were part of earlier in the year, and that was one of the issues. Can we make it more consistent? And they have. So it's a bit better in that sense, but there is a cap, and that's been introduced. And you can see from the slide, that's 30% of the qualifying employment income, or 300,000. So essentially, if you come to the UK, you're within the big regime. Then if you perform duties overseas, you'll get relief on those as well. There are transitional provisions, because as you can imagine, this does change how effectively the non-DOMs are taxed. So if you are a non-DOM, from the introduction of the new rules, there's 2 main sort reliefs that apply to you. The main one is the temporary repatriation facility, or TRF, makes it much easier to say, and that applies to 3 years. For the first 2 years of the new regime, you can remit your foreign income and gains that have been sheltered by the remittance basis to the UK, or designate it, essentially, pay tax on it at a flat rate, a special rate, so 12% for the first 2 years, and the third and final year, you pay 15%. And then you can remit those funds as and when. There is a bit more complication about designating and where their funds are, but there is a relaxation on the sort of what gets remitted and the mixed fund rules. So it's a bit welcome on that. The other one is a rebasing of foreign assets. It brings it in line with when the deemed domicile rules came in, 6th of April 2017, allows you to, your personal assets, if you held them at that date, there's other set of conditions, but you could rebase your assets up to the 5th of April 2017 values. Whether that's of much benefit, considering we're talking about rules that apply from 6th of April 2025, I'm not so sure. But the real big change was inheritance tax, and this is the one that really sort of got people worried. If you're long-term residents, so again, we look at the sort of a 10-year period. If you've been UK resident for at least 10 of the previous 20 tax years, then you will be considered a long-term resident. That means your IHT exposure will increase to your worldwide assets. People who aren't long-term resident will only have an IHT exposure on their UK-based assets. So it's quite a fundamental change. And this has been a slow but steady sort of reduction. It started for non-DOMs that they'd be deemed domiciled for IHT, so worldwide exposure on their IHT for 17 out of the previous 20. Then with the deemed domicile rules for all taxes, 2017, it increased the exposure when you got 15 out of 20, but now it's 10 out of 20. And that makes it very important to understand what people's residence position has been in the past. There was a concern that if you made a gift when you're not a long-term resident, so it's of foreign assets, so they're outside their IHT exposure, and then you die within those 7 years, but you die when you're a long-term resident, so that's within the exposure to your worldwide assets, will that be caught by IHT? And they've confirmed that that should not be the case. If it was exempt when you made the gift, that still should be exempt, but that can catch the other way. So if you made the gift when you were within the scope of UK IHT and then die when you're not, that gift will be caught, is how I understand it. So it's welcome, but actually you've got to think about it the other way as well. And there's a small transitional provision for those non-DOMs, as you probably heard, who've left the UK in this tax year. They won't be caught by the new regime, providing they're not UK resident for the following 10 years. So it's a welcome relief. Instead, they'll be caught by the existing rules, so they should be outside the UK IHT exposure on the worldwide assets after 3 years of non-residence. That doesn't obviously apply to UK DOMs. They'll be caught because if they left in this tax year and they're still resident and they've been resident for 10 years, the previous 20, then they'll be within their IHT exposure for next year. They'll be considered long-term UK resident. And that leads us on to the IHT tail, which was the big worry that you could be caught by these rules. And when you left the UK, that they would still apply, you'd still be taxable on your worldwide estate for inheritance tax purposes up to 10 years later. Well, they've listened and they actually have made it a bit better. They've softened the rules. So it's probably easier to explain it in a table. Essentially, if you were 10 of the previous 20 tax years, then you required 3 years of non-UK residence. However, if you've been 20 years tax resident, the previous 20 years, you will need that 10-year break before it falls outside of scope. And then that leads on to non-resident trusts, and their exposure is much greater, and that is where you've got a UK or a settler who's UK resident and still alive. For those trusts where the settler is deceased, then they won't be impacted. But where you've got a UK resident settler, whether they retain benefit in the trust or not, the exposure of the trust changes. So previously, if you're non-UK domiciled when you set up an offshore trust, the inheritance position would always be that non-UK assets are exempt. And that would continue even when the settler became UK domiciled. However, now it actually mirrors the residence position of the settler. So if the settler becomes a long-term UK resident, the trust, it has an exposure to UK inheritance tax on its worldwide assets. So that will affect the 10-year charge, and then also it will affect exit charges when distributions are made. They will be caught within the inheritance tax rules. You need to be careful, particularly where the settler is caught by the long-term resident rules and then leaves the UK and ceases to be caught by them, because that means there'll be an exit charge for the trusts, because they then come outside the scope of inheritance tax or the non-UK assets. There are some transitional reliefs. So if a settler gives assets to a trust but continues to benefit from them, then they'll be within the gift of reservation of benefit rules. So there's a double layer. The trust may have an IHT exposure, but also the settler. However, if they made the trust before the budget, effectively those rules don't apply. So there's not this double layer. And there's also for a qualified interest in possession trust, where the life tenant has the right to the income of the trust, again, for the non-UK assets, if that was set up before the budget, then the beneficial IHT treatment will continue up until the life tenant's death, or he gives up his interest. So I thought, actually, I've given you a quick run through of the rules. Let's look at what it actually means and some practical examples. So if we look at James, he's UK domiciled. He left the UK many years ago to work. He's worked in Asia, and up until last week, on his termination, he gets deferred payments. He's got his family in UK since COVID, and he has significant offshore investments. Not surprising, since he's been working offshore for many years. He wants to come back to the UK. His position is actually much better. So he's probably very happy with these new rules, because under the old system, he would have been within the IHT tax net on his overseas assets, and also he wouldn't have got any relief coming to the UK. As soon as he's a UK resident, he'd be taxed on his worldwide income and gains. Now, under this regime, he can have up to 4 years, depends when he becomes resident, of the FIG regime. And also he has up to, so in his 11th year, that's when his IHT exposure will increase to his overseas assets. So he's quite happy with these new rules. That's not something that would have happened for a UK domiciled individual. So it's a welcome, very welcome relief for him. Conscious of time, so I'll just move on to the next thing. What about Anna? She's non-UK domiciled. She came to the UK relatively recently, 2023-24 tax year. It's claimed the remittance basis and his investments in the UK and overseas. So she isn't too bad. She'll have 2 years of the FIG regime. So that allows her time to restructure effectively. It's less than she would have probably expected. She would have thought she would be able to claim the remittance basis for at least 7 more years before she had to pay any charges. So it's reduced the time that she's got of claiming it, of exposure to UK taxes, but actually it's not too bad. She has time. She can essentially plan accordingly. She's got the TRF she could use, the remittance basis income and gains that she's had. She could bring them to UK a reduced rate. But her IHT exposure and her exposure to UK taxation on her worldwide income and gains is reduced. So, but she has time. Adam is pretty much the same. He came nearly a year later, but he's in the same position. And that's where it sort of concentrates on actually time of UK residence is really important. In this example, he could have deferred his UK tax residence position to the following tax year, and he'd have got an extra year of the FIG regime. So that's where planning becomes really important. Don't necessarily come to the UK too soon. If you're towards the end of the tax year, just delay it. And that's quite interesting. In the advice that we had following the original budget, it was telling people, actually, you may want to think about coming to the UK a bit later than you'd actually planned. I'll then move on, conscious of time. So I'll talk on about the trust. So I'll do this one actually. So Amelia, she created a trust before coming to the UK. She then came to the UK slightly later. What's that mean for her? Well, she will have the FIG regime for 4 years when she comes. If she's, I don't think she is, but if she's settler interest, if it's a settler interested trust that she continues to benefit, the FIG regime will protect her on that as well. Essentially, for IHT, the trust won't be within the IHT tax net on its worldwide assets on the first 10-year charge because she's not a long-term resident at that time, but it will on the subsequent ones. And when she does become a long-term resident, that's when the trust will be within the IHT tax net, and that's when it has to consider the IHT exposure on exit charges. And then when she becomes non-UK resident, the trustees will have to be aware of that because they'll need to know when they cease to become be deemed to be within the UK inheritance tax net for all their assets, because there's likely to be an exit charge, and they'll need to understand when that applies and how to make the payment, just to make sure it's not missed. So in summary, and I realize I have had to sort of go over quite quickly, there's a significant change in how individuals are taxed, both income tax, capital gains tax, but then also more particularly inheritance tax. Non-DOMs, if they haven't already, they should use this final sort of 6 months to get ready for the new regime. Make sure that if they can claim the remittance basis, that they're structuring their assets as efficiently as possible. But then it also is important to realize that this actually, it can be beneficial. It allows UK DOMs to benefit from rules that weren't available to them before, albeit they are shorter. And because it's a short-term nature of the relief, it's really important that the UK residents' position, the timing of UK residents, becomes more vital. And it's important because this is big policy shifts. So within sort of the non-DOM rules, the idea behind that was that you entice people to the UK, they stay longer, and as they stay longer, they slowly but surely get more exposed to UK tax. It increases sort of quietly and softly on them. Well, this one is a short, sharp nature of relief, and that's the policy decision. That it's not really as an enticement, it's just you get an advantage for a short term. It's a very good advantage, 100% relief on your foreign income gains, but once those 4 years have gone, you know, that's it. Party's over basically on that, and you're exposed to UK taxation on your worldwide income and gains and assets. Will it make the UK an attractive destination? Well, it's hard to say, to be honest. I mean, it's not just on these rules. I think you actually have to think about the wider aspects, the wider tax landscape. And luckily for me, I don't have to keep talking. I can pass that over to my colleagues to go through and explain what that actually means for others. Thank you.
Thank you, Stephen. For those of you who don't know who I am, I'm Angus. I'm a director in the business tax team. And I'm here to talk to you about how this is going to impact people who are running businesses. So we knew that they weren't going to be going after the working man, whatever that was. And we thought they'd probably be going after the non-working man. I suspect what they meant is people who have a lot of passive income, but instead they've gone after the people who give us work. So we got hit with a double-edged sword. We've seen the rate of income tax, or not income tax, national insurance contributions go up to 15%. And we've seen the employment allowance coming down, or sorry, the threshold coming down to 5,000, which is a real hit to employers, and only softened by the increase in the employment allowance that has been given to now all employers, rather than just employers who have a amount or national insurance to pay of less than 100,000. So we have to be ready for this. This is going to be costly. The cost as a result of the reduction in the NIC threshold is £615 per employee. That's going to be a big hit, particularly for those industries where perhaps you are hiring lower paid individuals. To give you an idea of actually what this is really going to cost, if you have someone on your payroll earning £50,000, this is going to cost the business more than £1,100 extra in tax. So realistically, is this where the money is going to come to fill this so-called black hole? By the way, it was only mentioned 5 times in the speech. I thought she was going to commit more, but there we go. No doubt, I suspect this is going to be passed on. Will be passed on in terms of increased prices. We're going to see 40p more on a pint. Well, I hope not. But are we going to see it in reduced wage growth? Is it going to be impacting on recruitment policies? What about bonuses? Or the most extreme case, what about redundancies? So this is going to hurt us all, but at the same time, I suspect this is probably the right thing to do. We know that we have to raise money, and this seems a fair way of doing it to make sure that ultimately everyone's going to pay this. It's going to be through employees with smaller pay rises. It's going to be through people having to pay more for goods, and for businesses having to pay more NI as well. Just to provide a quick example of what this looks like for the owner-managed or the business owner. Let's say that you're looking to extract your profit of 250,000. Good for you, by the way. We're looking here at the difference between why don't you take that out as salary or as dividend. This change basically now pushes us more towards the dividend side. You'd be better off taking a dividend. That said, this is a very generalized point, and there are many factors that could build into this, which could flip this the other way. In particular, if you are involved in a business undertaking R&D, all you need to be doing is undertaking a little bit of R&D yourself, and this will flip the other way, and it will be better off for you to take salary. So the big takeaway here, I think, is when it comes to NI, you need to be looking out at forecasting the impact of this in your businesses, understanding how this is going to impact your recruitment policies, what this is going to look like for pay rises going forwards. Other employment tax measures that were announced was an increase in the national living wage. It's gone up to £12.21. And we're also seeing a move towards a single rate. So large movements for employees that are aged between 18 and 20. We've seen a whopping 16.3% increase. They got up to £10 an hour. I'm sure my children will be happy when they get that age. What else have we seen? We've seen continuing movement in the saga of the double cab pickup. It's very much a bit of a yo-yo, but now they've decided once again they are cars for benefit in kind purposes. We've seen the introduction of mandatory payrolling of benefits. Well, for most benefits that will kick in from April 26th, this will be for essentially all benefits other than loan benefits and accommodation. And we've also seen the continued freeze of the thresholds on things like the exempt amount for employee entertainment events. So that continues to stay at £150. It's been there since 2003. That's inflation beating if I've ever seen it. And business mileage reimbursement will also stay at 45p and 25p a mile, which it has been since 2011. So moving on from the employment tax measures, they also announced their corporate tax roadmap. It is not a particularly interesting read. It's more akin to, I'd say, the A1, just north of the Blythe services. There's not much to see, and a good chance it's going to be riddled with roadworks. So they have said that the corporation tax rate will be capped at 25% for the duration of this parliament. I will take that with a pinch of salt. I suspect that their spending plans will continue to push, and they are going to have to look at further tax rises in the future to help fund those. They have said that they're going to continue with our small profits rate for businesses with profits of less than 50,000. And as a result, the marginal relief that comes with that will continue. But ultimately, we still live in a very competitive regime compared to particularly the G7 and other nations in Europe. We still have a very generous treatment plan for our intangibles. So if you're holding patents, trademarks, goodwill can come into there as well. We have our substantial shareholding exemption, allowing you to dispose of businesses tax efficiently, which I'm not going to steal Jan's thunder. You'll come on to that further. We've got increased use, flexible use of losses, which has been widely or very well received. And we also have our R&D tax relief schemes, providing some excellent incentives to keep innovation in the UK. There were some announcements on capital allowances, mainly that they're going to be consulting. I think that's one of their favorite things to do. They like to consult. They've extended the 100% first year allowance on zero emission cars and charging points, which is good news. And just remember, those charging points can be installed in your own house. They said they will be exploring looking at extending the full expensing regime to include assets which are bought for leasing. They have said that they will look to do this when fiscal conditions allow. That's another of those pop phrases they like to use. They're going to be looking at the treatment of pre-development costs. This is mainly going to be looking at substantial capital projects, so solar farms, that sort of thing. And they've also said that we're going to perhaps have a look at the guidance that they provide for capital allowances to provide more certainty about what qualifies. This is an ongoing battle we've had with them for many, many years, that their manuals could be much, much better. On the R&D tax relief front, so we know that we're going to be continuing with our new merged RDEX scheme, but what they have released is some statistics regarding their attempts to curtail fraud within the R&D regime. And the table here really sort of tells the story of that. So back in 21-22, they suspected that 25.8% of all qualifying SME expenditure was either incorrect or fraudulently claimed. And as a result of that, there was a huge triggering of a wave of inquiries, which we've had great fun dealing with. And as a result, we're now seeing that that rate has now dropped significantly, coming down for SMEs down to 14.6%. And overall, which is taken into account very large company claims, down to 7.8%. So I think their crackdown seems to be working. Here's just some sort of more figures to get an idea of the state of inquiries. So the amount of claims that people are submitting has dropped significantly. So we expected this was going to happen, as a lot of the ambulance chasers, as we like to call them, decided to drop out the market when they realized that actually the company had to be doing some R&D to claim this. As a result, less claims. They were very proud to stand and say, yes, as a result, we're now processing claims much quicker. They say 92% processed within 40 days. I disagree. I'm not seeing that personally, but good for them. But we have seen the number of inquiries continue to increase, and it's increasing up to their target of wanting to look into about 1 in 5. So as the Hunger Games said, may the odds be ever in your favor. I think the shocking stat was the number of inquiries that resulted in a change in the claim, 77%. You'd be happy to know that our stats at PEM are significantly different to this, and our percentage is way, way lower. So that did a little flex. They also mentioned transfer pricing, and a lot of the time people just go, oh, transfer pricing. And I'm with you there, but they have said that they're going to be looking at this, and there's some good news and some bad news. So starting with the good news, they are looking into just scrapping the idea of transfer pricing between UK businesses. So this is where perhaps you've just got a purely UK group and you're having to apply some sort of transfer pricing methodology between intercompany sales. They're now just saying, well, look, we might just get rid of that requirement, which means a lot of people can save time not having to come up with quasi-commercial management charges to fix that position. They have, however, mentioned that they may look at lowering the thresholds for the SME exemption. So this is the exemption providers that you don't have to follow UK transfer pricing rules. It's currently set at something quite ambitious. So you've got to have more than 250 employees, and you're looking at 50 million euro plus turnover. So you've got to be quite large for that to hit, but they are looking at reducing that to bring more companies within the regime. There's a review to look at cost contribution arrangements when you are developing intellectual property. I'll not cover that any further, but probably one of the more troubling areas is this idea that they're looking to have cross-border transactions between related parties reported to HMRC. It's very early days. We don't know what that's going to entail, but what we're basically doing is tipping off HMRC to the fact that there will be potentially transfer pricing arrangements for them to look at. It's early days. They've just said that they're going to be looking into it, so there's nothing set in stone yet, but very much a case of watch this space. And really just to finish off, some other sort of slightly less crucial announcements that were made. So they have continued to hammer down on the loan to participator rules. I think the takeaway here is just don't try it. You're not going to succeed in trying to work around these rules. So the best thing to do if you can is if you do have an outstanding loan at the year end is just clear it off within 9 months and avoid the Section 455 charge altogether. They are looking into land remediation relief. So this is perhaps more applicable to your property developers. They're looking to see whether or not this is actually worthwhile. Is it actually delivering on what it's supposed to be doing? So we may see it removed or altered. We shall see the result of that consultation. And finally, for anyone who has a company that is housing, forgive the pun, residential property, and is caught by the ATED charge, they will be increasing those charges by CPI as expected. So with all this news, if you think you've just had enough and you want to pack it in, have no fear. My colleague Jan is here to talk to you about how that might look for you. Thank you very much.
Thank you very much, Angus, and thank you all for coming. So, I mean, I think clearly last couple of days, the main topic of conversation has been national insurance contributions. I think that's going to have a lot of conversations for businesses on recruitment and retention. But I think the build up to this budget is probably one of the strangest ones that I've had since I've been doing these seminars and last 12, 13 years. And I think there's been a lot of nervousness and really uncertainty. And there's been a lot of questions, what are predictions, what suggestions people should put in place before the budgets. And there has been a lot of transactions, which I really can split into three categories. We've had transactions which were in progress, and there was a commitment to get those done before the budget to make sure you knew what the rates were. There was also a lot of internal self-funded transactions where businesses had a lot of surplus cash and they were using that cash as an opportunity to do a management buyout where they don't necessarily need to go to third parties for lending, or there's been some share buybacks with the management team and the other shareholders being willing. Now, for that internal transaction, you typically have to go to HMRC, and they've got a relatively small team. I think I heard someone mention 6, but I think that sounds very, very small, of inspectors supported by a wider team. And we were sending so many clearance applications, and there was other revisors saying that they were getting questions back from HMRC to restart the 30-day clock. Now, I'm really pleased to say that we managed to get all the clearances through with no dramas, and that made a lot of certainty. And then there was a lot of liquidations and restructuring already in progress as well. So in a lot of cases, liquidation, you can get capital gains tax treatment, and there was some restructuring attached to those. And there was a lot of transactions, and our recovery team was heavily involved as well. But those ones are very tricky because you have to make sure you get the right capital gains tax treatment, because you can still be taxed as a dividend. So really, I think the last 4 months has been very much like an exam, very tense, very uncertain, and very high stakes in terms of what's on the horizon. So today I'm going to cover changes to capital gains tax rates and reliefs, measures that were put in place to stop any planning because of the changes, and other announcements. And third and finally, I'll go through some of the structuring and what you can do with a new backdrop in capital gains tax. So very busy table. As soon as we had the general election, I geeked out on capital gains tax history, as you do as a tax professional. Very exciting life. And the grey area is the position before the budget. And capital gains tax was introduced in 1965. We used to have a 30% rate. That went to income tax rates of 40%. And then over the last few years, it's settled to 18%, and then 10 and 20% for just a general rate of capital gains tax. Now, what we've always had since 1965 is some form of relief for business disposal, which has been around 10%. So we had retirement relief, which went up to 250,000. It was exempt. Anything above that, 50% of it would be exempt and taxed at the 30% rate, and then so on. And then we had taper relief. After a period of time, you'd get the 10% rate. Entrepreneurs relief was very, very popular, went up to £10 million lifetime limit of 10%. That dropped to 1 million in 2020 and was renamed as bad relief. And also we've had investors relief as well, which was introduced in 2016 as well. So what's the position post-budget? The main rates are going up to 18 and 24%, still lower than it was in between 2010 and 2016. But what we are seeing is a big shift in terms of how business disposals are being taxed. So until 5th of April 2025, we're going to have a 10% rate of business asset disposal relief. We still have the investor relief at 10%, but then from 6th of April 2025, we'll have a 14% rate. And then from 6th of April 2026, we'll have an 18% rate. So really, the reliefs are still very valuable, but they are reducing in terms of the benefit of those. So just a reminder, business asset disposal relief, owners who have got trading businesses, that might be sole traders, it might be partnerships, it could be companies as well. If you're a company and a shareholder company, you need to have at least 5% interest in that company. In the broadest sense, there's lots of requirements for that. You need to also be an officer or an employee, and you have to hold it for a period of 2 years, and that relief is up to £1 million of gains. And I think over the next few months, the differential was 14%. So on £1 million, that's up to £140,000 saving. From next year, it will be 10%, and after that, it will be 6%. So ultimately, it will be a £60,000 difference between having the relief and not having the relief. Investor relief really targeted at investors who are not working in the business. That was really something that people are not very much aware of. If you've been issued shares, subscribed for shares after March 2016, if you hold the shares for 3 years, then you can benefit from a 10% rate of tax as well, which will go up to 14 and 18%. Now, one of the things that a lot of also people are not aware of is SEIS and EIS. And this is really aimed at startups and scale-ups. And the reliefs on those are very, very generous. You get a 50% income tax relief. So if you put £100,000 into a SEIS compliant company, you get £50,000, up to £50,000 taken off your income tax bill. EIS, for slightly bigger companies, you get 30% taken off your income tax bill. And that relief is locked in if you've had it for 3 years. And the other benefits of EIS and SEIS is the capital gains tax relief. You can defer other gains into SEIS and EIS. And when you sell the shares, they come back into charge. And actually, there's a slightly more beneficial treatment on the SEIS. And all the growth in the shares are exempt from capital gains tax as well. Now, a lot of people sort of see that as an investor relief. But actually, for founder shareholders, you can structure it. You have to put a meaningful amount. So if you're looking at setting up a company, setting it up correctly with SEIS means that all the future growth will be exempt from capital gains tax. So it's a really challenging one because there are lots of requirements for the company, the investor, and general requirements. When you're starting a business, you are bootstrapping, you're being very careful. But I think that will make a big difference if you've got a really good idea and you use SEIS and EIS, that will definitely be very useful going forward. But I think with these reliefs, I think just planning early, looking at family shareholdings, looking at spouse shareholdings, just to make sure that you maximize those limits. In terms of with the increases in capital gains tax rates and also business asset disposal relief and investors relief, the rates going up, there are going to be a lot of closing down on planning opportunities. So any contracts that you entered into before 30th of October, which is completing after the budget, those will be scrutinised. Contracts after 30th of October, but you know that rates are going up and you're trying to play around with timing, those will be scrutinised too. You have to confirm that you're not entering into those agreements to obtain a tax advantage. Well, a lot of businesses, when they sell, the tax position on the CGT is one of the reasons they're looking to exit. And also, when you're doing disposals between connected persons, family members, you have to explain the commercial reasons for doing so. And if the gain is over £100,000, you're going to have to make a statement to that effect as well. One of the things that we mentioned is there was a lot of reorganizations, share exchanges, reconstructions. What you can do is if you can sometimes make an election to disapply a treatment historically and then benefit from lower capital gains tax rates. They've stopped that too. They've sort of said you apply the tax rates at the date of the election. So it limits what you can do in terms of timing on transactions, which were carried out before the budget, and also might have some tax implications afterwards as well. Other announcements which were mentioned in the speech is carried interest. Now, we've had a bit of a debate how people feel about this. Investment managers do have a preferential treatment of 28% on capital gains tax. Reason being is to make the UK investment market a lot more attractive. That's going from 18 and 28% to 32%, and there's actually a consultation to move it to income tax, and they'll be taxed the same way as everyone else is. So that's going to be interesting to see what happens in terms of the UK's competitiveness in that sector. There was also measures on liquidations of LLPs. LLP and capital gains taxation is particularly complicated, and people are looking at rebasing assets. Now it's very clear that all of the gain accrued on assets returned to members is subject to capital gains tax, and just closing down loopholes on LLP structures. Since 2016, liquidations have been a bit more difficult because there was a lot of companies which would wind up, get capital gains tax treatment, and shortly afterwards would set up all over again. And in those situations, since 2016, if you're doing the same or similar activity, you get income tax treatment. They are looking at now, looking at Companies House, HMRC, and the Insolvency Service to combat this phoenixism. I guess there's going to be record keeping on directors who are liquidating companies. And ultimately, if then they set up again, they will look at the phoenixism and the tax rules in those situations. EOTs, now with rates increasing, EOTs have been around for 10 years. And I think it's quite an interesting one because I think we've always third-party sale, typically in conversations, with our corporate finance colleagues, is one of the things that we would go first because you're more likely to get the value on day one and you get a premium. You might look at management buyouts, and you might look at share buybacks, and you might look at EOTs. Now, EOTs are particularly attractive for people selling. The whole concept is the John Lewis model. There is no disposal. There's no capital gains tax on the disposal for the shareholder, but all of that gain is taken on by the EOT. So once you're in that structure, it's very difficult to get out of it. But with the tax rates going up, then it's something that people will be looking at more closely. Since it was introduced, we had this tax-free employee bonus of up to £3,600 per annum. Very similar. This hasn't changed in 10 years. So the amount hasn't increased. And there has been a lot of tightening to the rules as well. So I think with CGT rates going up, the government is aware that people are probably going to be looking at EOTs a bit more closely. So to be able to have an EOT, you need to dispose of controlling interest. If there are any workarounds, former owners, then you will be denied the relief. When the rules were introduced in 2014, you could not discriminate in terms of where you set up the trust. We had European rules. Now these have to be UK resident trusts, but depending on what Stephen said, that might have not made a difference anyway. And ultimately, that was to just get around the CGT taken on around the trust. The EOT shares must be sold at market value, and they've extended the clawback for breaches as well. Now, with a shifting landscape and the tax code being so complicated, what you do look at is what can you do differently? So if capital gains tax are going up for individuals, is it still good for individuals to sell their shares in their companies? It's not just a tax, it depends on their own personal position, it depends on their wealth, whether they need to take those proceeds out personally. But this is a situation and a structure that we're looking at actively. So you need to weigh up capital gains tax on individuals. Corporation tax on the disposal of assets can be up to 25%, but all the reliefs that Angus was referring to, like the substantial shareholding exemption, can make a quite significant difference. So let's assume you've got trading assets in a company. What you can do is you can actually hive it down, transfer it down to a subsidiary, because it's part of a group. It's done on a tax neutral basis. That means the new business takes on the historical costs and so on, but there is no corporation tax. When you dispose of shares in a company that's received some asset, there is a thing called a degrouping charge if you do it within 6 years, and that earlier transfer you carried out will be recalculated based on the market value and added to the shares and the disposal proceeds on the shares. So you can potentially have corporation tax on the share disposal and a degrouping charge. However, since 2002, the SSE has been improved. So I think that opens up opportunities for people to potentially change their company into a family investment company. But you do have to be very careful that you meet the conditions. Otherwise, there has been a recent case where things went wrong and the corporation tax bill was quite significant. And that was the M Group tax case. So to summarize, what you have is, let's assume you've got Mrs. Smith. She's got Selco, trading assets being transferred, no gain, no loss. And what happens is then the trade co is then sold. Yes, you have a degrouping charge. It gets added to the trade code shares. And then you have a disposal of the shares, which potentially is subject to corporation tax. But if everything is structured correctly and you have SSE, there is no tax to pay on this disposal whatsoever. There is also other ways of setting up this two-tier structure. You can do a share for share exchange, but going back to the clearances, if you're just setting up a holding company as a money box, I think you're going to struggle to get clearance from HMRC. So it needs to be with other assets and other structuring plans. You can also use that structure is if you're looking to divest yourself of a trade and you have multiple trades and someone's not interested in the other trades. So this is why this relief is very valuable. Now, for the SSE, you need to hold shares, 10% of the shares for at least 12 months in the last 6 years. However, if you've got a group situation, that trade's been carried out for 12 months within a group, then effectively you can deem those shares to have been held for 12 months. And then you can effectively dispose of it. You get the substantial shareholding exemption, and that also covers your degrouping charge. However, there was a case, the M Group Holdings case versus HMRC, and that was a standalone company. And basically, they held the shares for 11 months. So if they held the shares for 1 more month, they would have been eligible for the relief. And then they also tried to argue that a standalone company was a group, which they also lost. And as a result of that, they had to pay £10.6 million in corporation tax. So again, quite a costly exercise. And the most basic of planning in these situations is if you have a standalone company, just having a dormant subsidiary, M Group wouldn't have had to pay this corporation tax. So because it would have had a group, even though it would have had a dormant subsidiary. So that's something that people who have standalone companies should think about if they want to dispose of their trade and assets without corporation tax. Now, what do you do? Because then you have your proceeds in the company. So you haven't, as individuals, access those proceeds. And we have different clients. Some of them have built up all their wealth within the company. And when they decide to sell their shares, that's effectively their retirement pot. We have other more fortunate clients where they've extracted funds over the years, they've inherited, they've got family wealth. And actually, it might be a lot better to keep the value within the company because corporation tax is lower than income tax. If you choose certain types of investments, you've got dividend exemption. If you have property investments as well, you can deduct interest on financing whilst it's been curtailed for individuals. So you've got the mortgage interest relief. But you also have to get advice because there are very complicated SDLT rules and annual tax on enveloped dwelling that if you don't get advice are very, very expensive as well. The reason also that family investment companies are possibly more popular as well is that, as everyone knows, shares have got 3 characteristics. They've got rights to decision-making, voting, they've got right to income and right to capital. So the older generation can keep decision-making, but all the right to income and capital can flow to the next generation. And also, you have a lot of flexibility in those structures as well. So they're really good for growth and flexibility. But I think the key thing is before you put those structures in place, you speak to our private client team because there might be some reliefs that as shareholders you have, what's this, a trading business? And effectively, once you've sold your trading business, then it limits your options and what you can do. So I think this is a all tax teams' advice is private clients, corporate tax. Also, if it's properties involved, there's going to be some VAT and XDLT advice as well. But this is something that I think is going to become more and more popular. And I'll pass you on to Sancha. Thank you.
Thank you, Jan and Angus and Stephen. Now, Rachel Reeves, she ran over by 50% when she spoke on Wednesday. We won't do that quite, I don't think. I'll try my best, but as you know, we've always saved the best till last. And there are one or two things to talk about in the private client and inheritance tax world, and that's what I'm going to be focusing on mostly today. There are three little things other than inheritance tax I'm going to mention. The first is the change in stamp duty land tax. From April coming, the nil rate bands are reduced. That's a reminder, we knew that was coming. The first time buyer advantages are also reduced. The irritation is that they are increasing the additional rate to 5%. And that is the amount that you pay if you're buying a second or more properties, so beyond your first home. Also, if you don't have a simultaneous exchange and completion on your current home and you buy a second one, you're going to have to pay that 5% up front and reclaim it later. So please do make sure those conveyancing teams amongst you that you are aware of these new rules and they are coming in. If you exchanged before yesterday and there are no changes whatsoever in your contract, then you probably will get away with the last lower rate. But if you're exchanging from yesterday onwards, you will pay the 5%. For companies, they've increased the flat rate to 17% for purchases over £500,000. Basically here, they're trying to look at companies who are allowing related parties to occupy residential property. So there are exemptions if you're looking to develop or if you are renting it out commercially. I'm going to mention this because it's an irritation to some of our colleagues who are here. The high income child benefit charge, they were trying to make it fairer under the Conservatives. It's payable by high earners and the intention had been to look at both parties of the parenting household to make sure that you looked at the limits rather than just the higher earner. But frankly, it's hit somebody's too difficult to do list and it's not going to proceed. Going forwards, if you find you've got a charge, you can have it paid through your tax code. And the Inland Revenue are going to pre-populate your tax return if you've received this. I guess one or two people might be forgetting they've had it and not paying the high income child benefit charge, because clearly in a family, one person receives it and the other person pays for it, whichever way around that is. And the final little point I want to mention is the interest that we're receiving from the Inland Revenue when we have an overpayment. They are generously paying 4%. And they like to stick at that. They're not going to change that because it's tax-free as a receipt to us. But note, they don't think it's enough if you owe them. If you owe them, they're going to charge you quite a lot more. So it's going to be base rate plus 4%. Which at the moment makes it 9%. So if you haven't paid your tax, I suggest you get on and do so. So looking at your personal estate, we're looking at the inheritance tax changes, and I'm sure you'll have read about some of these. Just as a reminder, the basic rate band, that's going nowhere. The residential nil rate band is going nowhere until 2030 when they might look at it again. It's interesting to note that if it had been increasing with inflation since it was introduced, we'd be looking at £500,000 as our nil rate band and quite a lot more overall for the residential nil rate band. So they're not being very generous. It's tax by stealth, effectively. Pensions. What do I say about pensions? They've always been protected from inheritance tax in the past. Don't touch your pension fund. Take your own money, spend your own money, leave your pension fund. It's free of inheritance tax. That is all changing. great news for the IFAs in the room, because they're going to be talking constantly with their clients about their pension funds going forward. So this is where you've got an undrawn pension fund at death, and it can be inherited. Apparently, the pension scheme administrators are going to pay the tax. How they're going to calculate the tax, we don't know. We've got some ideas as to how they might do it. And we're taking bets as to whether they're going to do it the fair and equitable way, or whether they're going to say, give us the cash. My bet's on the second one at the moment. But the good news, and there is some good news in this budget, is that there's been no change to the tax-free cash that you can take out. There's no change on the higher rate tax relief on the contributions you're making, which is irritating to those of us, and I'm sure I'm not the only one who plundered spare cash to make sure I topped up my pension before the budget. But it does mean that all of us need to look at our inheritance tax position, because we've always historically said this is outside the scope. It was a bit like VAT, it's outside the scope, but it no longer is from April 27. We've got some time, it's not until April 27th, but let's look at what happens. So Jill, she's got a personal estate, she's a single lady, her personal estate's worth £800,000, her pension £700,000. And she's only going to pay inheritance tax of 120 at the moment. But from April 27, that relief on her pension pot is removed, and she will now be paying, or her estate will be paying, £400,000. That's a very significant increase in the amount that's paid to the Treasury, and a decrease in the amount that's going to be received by her beneficiaries. It's a bit of a pain. There has been a little bit of good news for any of the farmers out there. I suspect they haven't heard this, and frankly, I suspect it's not going to make any difference at all. But let's talk about the good news first. There's an extension to the property which can benefit from APR relief, and that is extended to land that's managed under government environmental agreements. There's a lot of information on there, but I'm not going to talk about it because frankly, I don't think it's going to be relevant when you start looking at the next slide. So inheritance tax. If anyone wants to leave now, it's a really good time because it's going to get depressing. So previously, if you had an asset that qualified as agricultural property, even if it was a farmhouse or business property, it was 100% relieved from inheritance tax. There was no inheritance tax so long as you met all the qualifying conditions. It's gone. It's capped. The 0% tax is capped at £1 million, and that is split between your agricultural and your business property. And it'll be split in proportion. So if you've got £4 million worth of agricultural property and £6 million worth of business property, it will be split in the ratio 4 to 6. After that, what happens? They're going to still be generous, apparently. You can still have a 50% relief, but it basically means that on any value of a business asset or an agricultural asset that exceeds that first £1 million cap, you're going to be paying effectively at death 20%. That is going to cause a real problem, because genuine businesses that don't need their assets sold to continue are going to have potentially a dry charge. They're going to have to find 20% tax from somewhere. But it doesn't only apply on death. It also applies on lifetime gifts. Those gifts perhaps you would historically have made into trusts, and more about them later. So what does it really mean? Again, let's look at Jill. So she's now got £10 million worth of qualifying property. At the moment, the whole of it is relieved and she pays no inheritance tax at all. From April 26 going forwards, she's got £10 million worth of qualifying property. The first £1 million will be taxed at 0. The remaining £9 million, 50% of it will be taxed, and she's actually going to have to pay £1.8 million For those of you here who are a little worried about the fact I've ignored nil rate bands, that's what I've done because it just made the maths too difficult at this point to explain it to you. But ignoring nil rate bands, she's got £1.8 million worth of tax to pay. And let's say that all of her qualifying assets is farmland. How's she going to pay the £1.8 million tax? You can pay it over 10 years if you wish to do so. But if you think of the rate of return on capital for farmers, it's pretty low. And over 10 years, the income is not going to pay that inheritance tax. So I think something's going to have to be sold. And for those of you who are slightly worried, because I'm still in the old language, APR and BPR, they changed it. The Conservatives changed it to AR and BR, but Rachel's brought it back as APR and BPR, and I'm sticking with that because I'm old-fashioned and it sits very much comfortably in my vocabulary. Other changes. The good news is if you've got an asset at the moment that only qualifies for 50% relief, so you've got property outside of a company that's your family company, for example, they're not going to halve that. You still get the 50% relief. So that's good news. Obviously, they are bringing in some anti-forestalling. You cannot start planning today and give something away before April 26 and expect it to be under the current rules if you die in that short-term period. It's going to be caught. And you cannot transfer your allowances, your £1 million tax-free allowance, between spouses. So it's going back to Jan's point where he was talking about structuring your company. Get that structure right as soon as possible. Make sure both spouses are genuine business partners or business owners, because that's going to be important going forwards. I don't know if this is good news or not. One extra amount of relief is that if you have shares, if you've done some inheritance tax planning and you have shares in an AIM portfolio, or I'm going to have to read this because it was a description. Shares designated as not listed on the markets of recognised stock exchanges. If you've got any of those, and believe me, lots of people do, because it's been great inheritance tax planning. If you don't own your own business, you can have shares in somebody else's business and get 100% relief on it. You can't anymore. And what's more, the first £1 million that you can have tax-free doesn't seem to qualify for those. More information to come in the future, but we don't think it qualifies. But you can have as many millions of pounds invested and get 50% relief, so you'll only pay 20%. Better perhaps than a holding in the normal stock exchange. Well, you'll have to take some advice on the risk of that because they're much more risky. Their return tends to be a little bit lower. And if you're only getting 50% relief, I suggest there's going to be a little bit of adjustment in people's investments. Trusts. I don't even know if the government have thought about trusts on this. I assume that they have. But let's think of all the trusts in all the wills and all the lifetime planning we've previously created. All of those trusts are now going to not be able to claim APR or BPR the next time there's a charge. We've got millions of pounds worth of farmland in trust. We've got millions of business assets in trust. The good news is if they're old trusts, they can have £1 million exemption each. But anything over and above that is going to be taxed, only relieved 50%. Coming out of a trust, if you've got an exit event or you've got a distribution, you've got the 6% charge. So you've got issues there. Every one of those trusts is going to have instances that go forward where tax is going to be payable. The detail is decidedly short at the moment, decidedly short, and there's going to be a favoured consultation and we'll see what they come up with in the new year. But let's look at the example on that. So we've got £10 million worth of qualifying property in a trust. At the moment, at an exit event, if you make a distribution, there's going to be no tax. From April 2026, the first £10 million is going to be tax-free. After that, it's at 50%. So 50% of 9 is 4.5. So you're going to tax 4.5 million. Now we are on an exit event or a distribution only going to pay 6%. unless they start to change those rates as well, but they haven't mentioned it yet. But again, you've got £270,000 worth of tax you've got to find. And often these trusts hold assets that don't generate any income at all. So suddenly you've got a trust that's got to pay tax and it has got no money to do so. It's going to be a problem. So let's look at the overall impact, and I'm really conscious of time, and I promise no more than 5 minutes. The overall impact for an individual. Let's talk about Rachel, shall we? Let's assume that she's a widow. She's got transferable nil rate band, which is lucky. She's got a main home worth £1 million. She's got an interest in possession trust of 2 million. And she's got other assets, which at the moment she doesn't pay any tax on. So she's got qualifying agricultural property, qualifying business property, 10 million in total. And she's got a pension outside the scope of inheritance tax worth £700,000. So if we were to build a personal balance sheet for her, it would look something like this. So her total assets are worth 13.7 million. The tax on that would be £940,000. So the net worth of her estate that following her death would go to her beneficiaries would be £12.76 million. Not bad, not bad. And then we have some new rules. And notice they've all gone pink. Everything on that list is going to be taxable from April 27 onwards. And it's going to have a really big impact on the amount of tax that she pays. So again, looking at her personal balance sheet, she's still got £13.7 million worth of assets before we start taxing it. But the assets are going to suffer tax of 3.02 million. Instead of less than £1 million, it's more than 3. That's a very significant difference. And her beneficiaries are going to get a heck of a lot less. So what can you do? Well, obviously, some of these rules aren't coming in straight away. Yes, we have some anti-forestalling, and yes, we don't know what that's going to be entirely at the moment, but it's certainly worth taking advice. Your circumstances are different to the person sitting next to you who may have the same financial situation, but what you want to achieve is going to be different. So take advice. Things you can still do. You can still make lifetime gifts that are pets. We were quite surprised. We thought they might go. You can still make gifts out of excess income. We've got these pension fund things that are going to become taxable shortly. So people might start saying, well, I'm not going to leave them untouched. I'm going to take the money out of my pension, pay tax on it now, and then give the excess away, because that means I'm not going to pay inheritance tax on it down the line. Depends on your personal circumstances, depends on the rate of tax you're going to be paying as you pay income tax on it. But I think that could become very much more prevalent in the future. We can still do deathbed planning if we want to. It's part of nature. We're all going to die one day. And if you can structure your affairs between you and your spouse efficiently, you can get a capital gains tax uplift on the assets when the first spouse dies. So the second spouse can sell them without any of this increased capital gains tax. I think that's something that we will see more of. You should, particularly if you've got business assets, you should be reviewing your wills. A lot of wills that we have talked to our clients about over the recent years will always say, and all of my business assets that qualify for 100% will go into a trust, expecting that most of the business assets will go into the trust, and that will enable the business to carry on appropriately. But if it says that, those assets which no longer get 100% might turn up in the hands of the spouse. Now, that might be good news, but in many business cases, it's not good news. It's not what was intended. So anyone who's got one of those business property clauses in their will probably needs to start looking at the will with their lawyers, who are going to be very happy with this. It's time to look at them again. And probably we'll have some more life assurance. You need to structure your businesses correctly. Jan has talked about family investment companies. It gives you lots of flexibility. We could put some growth shares in there so that the growth doesn't hit your estate. It goes into one of your children's estate. We should look at that with you. We should, as I said earlier, make sure that both spouses are using their allowances. Make gifts now. They could be personal gifts. They could be pets directly to people. They could be into trust. They could be through these growth shares. Get that growth outside of your estate. If you've got a trust, consider breaking it before the new rules come in. We have to think about that and see what the anti-forestalling says early next year, but that may well be a choice. And we can still continue to hold over capital gains tax into and out of a trust. So the big point here is there have been very significant changes, and our hands are a little bit tied because we know there's going to be anti-avoidance, but we don't quite know what it's going to say yet. Typical. So whoever you are, whatever you are, and I'm not going to talk in great detail about the rest of the next 2 slides because we are really running over time. Now is the time to look at your personal circumstances. What's right for you is not necessarily right for the person you're talking to in the pub. What you see on the internet, and we get clients saying all the time, I've just seen this, I'm one of these, and I've seen this on the internet. It might apply to you, it probably won't. It's far better that you talk to us and get bespoke advice that suits your circumstances and works for you and your family. And getting that family succession planning done early is going to be critical going forward. So look at your position and please do come and talk to us. And I was going to give you the usual spiel about, you know what she's done, this is where we are, and is it good, blah, 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 blah. I'm not going to do that because it's 17 minutes past 10. And I really appreciate that you have sat and listened so patiently to all of us today. As Warren said earlier, you've had the opportunity, well, it's not on here, opportunity to do Slido questions. If you want answers, we can talk to you afterwards. If you want to leave a message or leave a question on there, we will get back to you. Either we will telephone you or we will email you, but we will publicise the answers to questions. Warren, do you want to say anything else?
Yes, very, very good. Thanks, Sancha. As Sancha says, thank you, everybody. Apologies for overrunning. When I said that we probably wouldn't have time for Q&As, that didn't actually mean don't ask any questions at all. But as Sancha said, the team are going to be here for a little longer. There's still probably coffee and maybe even some bacon rolls left if anybody missed them earlier. The only other thing I want to say is thank you very much for joining us, but also to thank our fantastic speakers this morning and to say have a fabulous rest of the day.